Perfect. Great to be here. Last but not least, the final panel for today about banking on blockchain, the future of finance, definitely. When I was asked to moderate this panel, and my background, I'm sitting on the board of the Bundesblock and on the Hanseatic Blockchain Institute, and my own company runs some investment vehicles for crypto assets. I was thinking about, so let's talk about the future of German banks regarding to blockchain, and I was expecting to have some people from the large German banks here on the panel, from DZ Bank, from Deutsche Bank, from maybe the largest Sparkasse in Germany, which is the Hamburg Sparkasse. And well, I'm delighted to have two coming from the US, one from Switzerland, and Christoph, it's great to have you here. To start with the kind of most prominent issue, maybe, the traditional banks appear to have spent the last 5 years in permitting their clients to buy blockchain-based investments, e.g. Bitcoin, at the counter, kind of. Are the traditional banks in Germany aware of this wave that's going to come, or what's your view, Christoph, on the German sentiment in the banking sector?
I think it's a really good question. You have to see it in a different way when looking at readiness of banks. So you have clearly some which are in the forefront, heavily focusing on this topic. So we as Union Investment, by the way, we are not a bank, but an asset manager, but we belong to the cooperative banking sector in Germany, which represents Volksbanken and Raiffeisenbanken in German language. And as a cooperative banking sector, I think we are doing a tremendous job. As an asset manager, Union Investment, we are heavily focusing on these topics. And I think it's a kind of magic triangle. It's not only DLT, but at the end, we talk about digital transformation. So it's DLT, it's AI, and also quantum computing. I think
the German banks, are they prepared, or do they have no clue where it's going to go?
We as a cooperative banking sector, clear answer is yes. You have a number of banks not really taking care about this topic. That's why I'm a strong believer in 5 to 10 years' time, 20-30% of the existing banks, they won't exist anymore because they are overrun, falling in the kind of Nokia trap, how I like to describe it. So having a high market share, being highly successful right now, but not focusing on digital transformation in the right speed. So therefore the answer is yes and no, some more, some definitely less, which I think is not the right approach.
Good. So I didn't ask you to introduce yourself because everybody knows you're here. Maybe the others have a short opportunity to introduce themselves and tell what their organization is doing. Philipp, if you want to start.
I'm from Solana Foundation. We're a global organization supporting the development of the Solana blockchain and any use cases on it. And in my previous life, I've been a banker too, so that's kind of a very fitting panel for me.
Perfect.
Yeah,
Claudio.
yeah, probably also for me, because I'm leading the growth here in the region for Gemini, that is a US exchange. But previously I was MD and general manager for N26 German banks in Italy and Southeast Europe. And before that, I had my own company that works very close with Intesa Sanpaolo Group in Italy, that is the largest bank in Italy.
Yep, and great to meet you all. My name's Ryan Zega. I work for Aptos Labs. So we're a technology company that works on a number of projects on the Aptos blockchain. Prior to joining Aptos, I worked for a broker-dealer called T0. So we were kind of bridging the gap between, TradFi and DeFi. So we were doing RWAs when they were STOs. So I was there for about 5 years. And then prior to that, I did TradFi. I was working for a couple institutional commercial real estate companies and acquisitions, asset management, and debt origination.
Perfect. Maybe starting with you, because you just mentioned that you're traveling between New York and Japan and Germany. So what's your view on Germany? Is it the highest developed as regards the ability of the traditional banking sector to adapt for the challenges blockchain is likely to bring across?
Yeah, so I've been doing a lot of international travel, and a lot of discussions have been around sort of Genius Act, Clarity Act, the White House Digital Asset Report, and then how other jurisdictions can, implement similar changes, right? Regulation around stablecoins, and I think there's also a high interest, right, in sort of Germany and other jurisdictions. It's, potentially a bit slower than what we're seeing in the US, but yeah, whether it's, Japan, Korea, Hong Kong, Germany, high level of interest, and then, TBD on the sort of, I guess, like speed of execution.
Claudio, from your experience with N26, so that is, it is a new bank, and trying to fit the demand of a younger customer group. How relevant was it or is it for a bank like N26 in comparison to Commerzbank, who's not even around today, to digitalize, e.g. to adapt products, demands that are on-chain or are even crypto assets?
Yeah, I think, we are clearly in front of an innovator dilemma for banks now, including, I think, digital banks too. As you know, N26 rely on an external partner for delivering crypto. So it's not just technology, it's not just, a P&L problem, because in the end, it's like offering blockchain solution can be a very big problem for P&L for traditional banks. I think that in the end is more like a relationship problem, because in the end, banks now, especially traditional one, at least on retail side, are owning customer through relationship more than products. And now we are seeing more competition coming from different players, not just exchange, but investment firms and so on, that provide different kind of products. And yeah, I'm with you, Christoph. I don't see a lot of banks survive in the next 5 to 10 years, to be honest, because they are not, I think that they are completely aware of what's happened. It's just risk management now, as I say, more on the P&L, and in some way also with regulators' reputational side. We see that, for example, I'm coming from Italy. We see that every day. We have a governor for Bank of Italy that is completely against crypto. So traditional bank can't jump completely on crypto. They are just acting behind the scene, but it can be too late at one point,
Right. Philipp, I mean, Solana is acting globally, interacting with financial institutions worldwide. How do the people at Solana see the German market? Is it overdeveloped? Is it fast? Is it slow? Or what's your
I would say it's been like two different eras when we think about last year and this year. I think last year it was with Mika, everything's like on a steady track, going there, finally being implemented, getting traction. While in the US, things were not just like uncertain, but really a hostile regulatory environment. But now, things completely changed, and it's having this kind of seeing different projects. It's pretty impressive to see how when US companies, once they decide going one way, they have the capital, they have the talent, and they have the risk-taking mentality. So I think right now they're just running ahead, and Europe and Germany being left behind.
Christoph, coming back to you, we just heard from Bullish that they set up their European entity in Germany because BaFin is said to be the strictest regulator, and they wanted to fulfill their requirements. So I think, in fact, the German and European regulation is significantly harder than in the US, than in Asia, and so on. Is this an advantage because we are more reliable because of our sharp regulation, or is it a disadvantage? What's your experience if you compare your ability to make business in an international context?
From my perspective, Moritz, it's clearly a competitive edge. So a benefit we have here in Europe. I think regulation, regardless whether you look at crypto assets, cryptocurrencies itself, or whether you look at tokenization of traditional financial products, regulation is really key. So what is the key objective of a regulator? Take German's BaFin or take ESMA on a European level. It's on the one hand protection of retail investors, and it's on the other hand assuring financial stability. And I think our industry is heavily based on trust. We've had in one of the previous panels the term trust-fi, which going forward plays a key role, and that's where we need clear guidance from regulators. Here in Germany, we've had most recently BaFin Tech. That's a conference which takes place every 2 years in Berlin, hosted by German BaFin, our national regulator, and Deutsche Bundesbank, our national central bank here. And the key message which was given from head of BaFin and head of Bundesbank is, on the one hand, we want to allow innovation. We want to collaborate with the industry, with the various stakeholders when it comes to collaboration. But on the other hand, we have to assure that financial market stability is given and that consumer protection is given. And I think looking at accidents in the crypto space, which happened over the last couple of years, just take FTX. I'm sure such an accident here in Europe, we never ever would have seen it. And everyone is aware that FTX was causing a crypto winter, where out of a sudden the entire industry didn't talk about crypto anymore for 6 to 12 months. And therefore I think you have to clearly find a balance of allowing a maximum of innovation, but on the other hand assuring the kind of core pillars of the financial market, and I guess that's what we achieve here in Europe in a fantastic way. We've had a discussion about DLT pilot regime. Yes, we've been first here in continental Europe, and some of the elements need to be amended right now. That's where the Commission is working on with regulators. But I think here in Europe, especially here in Germany, we have very proactive regulators, and we also, as Union Investment, we are in in-depth discussions with BaFin about investments in tokenized bonds, about discussions about launching, issuing tokenized fund shares, and our experience is they are really supportive, and it's quite fruitful discussions we have with them.
Fair enough. However, question being, do clients care? And maybe that's a question to you, Ryan. I mean, in the US, we have more than 50 million holders of crypto, and even though there was little to no regulation, and yes, Germany, we have some 10 million maybe. Do you think what Christoph says is right, that we need to have a very strict consumer protection and regulation, which makes things much slower, or if we want to support the market, we need to be a little bit easy peasy?
It's interesting, right? Because it's a two-sided, kind of viewpoint that we have, right? For regulated products, right? You have a number of innovative financial institutions, Franklin Templeton, BlackRock, JP Morgan, Citi, you name it, that have large digital asset divisions where they're launching products, a couple of which are like money market funds that are issued, on different blockchains, Aptos, Solana, you name it, right? So you have these instruments that are kind of going out to a more, crypto curious, right, blockchain curious audience, and then sort of outside of this regulated space, you have a number of blockchain native or crypto native products that are trading on centralized, decentralized exchanges. And then you have innovative companies like Figure that are actually natively issuing HELOC products. So I think it, kind of depends, right? You do have a number of investors that are actively seeking something that's more blockchain native. And I think the companies that are really going to be, innovative like Figure are actually, utilizing blockchain in a manner that's, more, I would say, Web 2 friendly, right?
Yep.
Where you're not necessarily noticing the use case of blockchain. So I find it fascinating. I'm very happy to see, sort of this convergence of like, traditional capital markets and more, blockchain intensive, types of rails.
Yeah. Maybe let's focus a little bit more on the future of banking. And frankly, with the Web 2 development, we have seen that afterwards there were hardly any travel agencies anymore, because all the functions of a traditional travel agency was taken over by something that was achievable by the individual via a digital technology. And the claim, at least, is that Web 3 will enable each individual to do what used to be a privilege of a regulated financial services organization by themselves. And I think all of us here in the room, at least, know that technology is there. We can have cash, we can do transfers, we can buy securities and even derivatives online without a bank. And maybe this question goes to you, Claudio. So how does a traditional financial institution needs to position itself to ensure that's not going to happen the same as the travel agencies, that they are not needed anymore? What should be the strategy to embrace or to cover the risk?
Well, again, I'm coming back to the relationship topic that I mentioned before. So banks, traditional banks, have the privilege to have millions of customers, relationship, and sometimes, probably often, they also have product that lock it in the relationship, like mortgages. It's like and in some way, it's a big advantage. Offering something that is simple to use and in some way hide the complexity behind, to be honest, 95, 98% of the people, retail market, doesn't care about what happened behind. Doesn't make any sense to promote technical words, talking about blockchain, talking about education with too much. It's too much. Sometimes it's just too much. People they just want to make transfer during the weekend without hassle. Stop. So if if traditional banks are able to transform itself and keep the relationship, leverage technology through a good UI, probably in a couple of years because of AI, we don't see a UI anymore, but at least having tools and interface that are simple to use and are able to integrate and operate, probably also with some innovative companies to provide new products that are useful and the needs is clear in the customers, can be probably something that helps traditional bank to survive. If not, we are just seeing digital banks, Revolut, N26, whatever, that are just converging and integrate everything. On the opposite, you have here in Germany, Trade Republic, Bitpanda, other investment company, you can say, and exchange that are made the same job. So we are converging, offering everything. At one point, probably an exchange like Gemini can provide 95% of the product that a retail customer needs in terms of tokenized stocks, staking, compared to a deposit and whatever. So it's just a matter of time. And again, building trust and relationship takes time. If traditional banks will lose the game, it's just because they are not able to manage the next few years to translate how they make their works.
Maybe to take another perspective, Philipp, from your point of view, from the point of view of Solana, individuals are interacting with Solana actively, that's what we know. Does your business model need banks as an intermediator between individuals and the blockchain, or is your kind of focus something where you say that banks will at some point in time become entirely irrelevant?
Well, what we see is like where the innovation happens is on the retail side, where it's fully permissionless, and the innovation and the trial and error basically happens in real time in production, and it's not 24-month product design cycle to get something out and try, but it's like it's coded and a few days later it's on chain and tried, and that's why it's this extremely high rate of innovation. But in that world there is no intermediary needed, right? It's the permissionless world. And that is the disruptive energy and the disruptive, like, from a bank's perspective, the risks. So the question is really how to embrace this disruption and be part of it. And I think there is one way, at least as of today, is this regulation builds a bit of a protection as well, because a lot of incumbent large players, they will only go and do it and launch products if they have absolute clarity. The way this happens now in Solana is you have the blockchain is permissionless, but the tokens are permissioned. So the holders are whitelisted, the issuer can mint, burn the tokens, etc. So I think the innovation part is going to be on the retail side. Then there's like some middle ground, and like over time we're being like now this permissioned way of things being embraced by larger players. Also, I think in the last 12 months, the stance, like banks wouldn't touch permissionless chains 12 months ago. It was a complete no-go. It's warming up now because they see the benefits of it. So I think it's really the tricky questions for banks is how to survive in this disrupting technology. And I think one angle, you mentioned the relationship. I would say crypto still has a UX problem. Like the interface is still not where it needs to be to onboard a billion users, and that's probably where they can have a good role helping, as they do now already, right? Helping the user guide through the plethora of products and technologies there is there and make it easy to use.
Looking at the hurdles for quite a while, blockchain technology was somehow scary, and then more and more people understand that this is a technology that has some level of reliability. However, most assets that are traded are highly volatile, which is the second kind of hurdle. And now what we have seen over the last, I would say, 3 months is really a large stablecoin development, which takes out the risk of volatility, at least. From your point of view, Christoph, is stablecoin changing everything? Because now the second largest fear is no more around, and you can use the blockchain as the infrastructure without being automatically exposed to volatility, or is the impact irrelevant?
I guess I wouldn't agree with when we're looking at tokenized instruments that they are by definition embedded with high volatility. When looking at Bitcoin, Ethereum, Solana and co, yes, we've seen in the past that they were characterized by higher volatility. On the other hand, for us as an asset manager, tokenization of traditional financial instruments also plays a key role, and a tokenized Siemens bond by definition is not more volatile than a non-tokenized traditional Siemens bond. Take Mercedes as a share, or IBM in the US, when Robinhood tokenizes IBM shares and puts a wrapper around the swap. This instrument is not more volatile than a traditional IBM share. So I think it's a kind of myth we should at one stage stop with saying that crypto assets, tokenized assets, they are by definition highly volatile. Looking at stable coins, we discussed it in one of the previous panels. Is it the kind of silver bullet which solves all problems on the payment side? My answer is clearly no. At the end, when looking at cash on chain, I highly appreciate the setup we have here or will have in Europe going forward. We will have stable coins, we will have a commercial bank money token, so tokenized deposits issued by banks, and we will have as a third instrument wholesale, and I underline wholesale, not retail, wholesale CBDC. And I think that's, from my perspective, the perfect ecosystem. Coming back to your questions on stable coins, here in Europe, defined under MiCA, stable coins are non-yield bearing assets. And I think this is, for a long-term holder of digital cash, this is a significant showstopper. So we as an asset manager, when having cash positions, would we ever go in stable coins? Clear answer is no, because we wouldn't fulfill our fiduciary obligation. Today, when we have cash, our custodian pays us ECB funding rate, and I can't replace, just for the sake of easier settlement, I can't replace bank deposits where I get yield with stable coins, where by definition the issuer collects the yield and doesn't pass through anything to us.
Yes, but I mean, you can use stablecoins. It gives them protocols to generate yield at sometimes quite attractive rates in yield farming, staking.
You have two possibilities. You have staking, where you lock your cash, and by definition, as an asset manager, we can't work with locked cash. So by law, it's not allowed to lock the cash for a certain period. Cash needs to be available full time. And when going into yield farming, when you take out the cash, you don't get any yield paid. And therefore, from my perspective, for the professional financial industry, solution is commercial bank money token in combination with wholesale CBDC. That's why we are highly supportive for the ECB and for Bundesbank when it comes to Pontes. So that's the first stage, which will go live August, September next year. I think there are a number of use cases for stable coins. So it's not that the one is in the good and the other one is in the bad one. Stable coin, when you look at crypto native investors, when you are invested in Bitcoin and you take some profits for a very short period of time, you want to remain on chain to park your cash, you easily go into stablecoin and you give a shit about whether you earn yield or not. When you make 30% plus with your Bitcoin, you don't care about 2% you get for half a month.
Yeah. Ryan, what's your thoughts about are stablecoins potentially a game changer for adoption and usage of
So I'd say in emerging markets, yes, we're seeing a lot more utilization with neobanks, other types of financial institutions where their underlying investor base, right, their user base likes to transact in USDT, USDC, whatever it may be. So we see a lot more interest, I would say, in those emerging markets, particularly with stablecoins that are U.S. Treasury backed. It'll be interesting to see what occurs in sort of, the APAC region, Europe, and other domiciles with non-U.S. Treasury backed stablecoins, right, of different currencies. So we'll see, what adoption looks like there. But yeah, we're seeing a lot of interest in mainly emerging markets, Latin America, the African continent, parts of the APAC region.
Yeah, I think we need to differentiate between the crypto as an asset class and as a financial infrastructure. And the asset class, always been very volatile. Bitcoin, Solana, Aptos, and probably will be for quite a while. And then the financial infrastructure, we use the term internet capital markets, is things people in crypto have been talking about for years, but now it's actually happening, like all these financial products coming on-chain. And then, they're as volatile as their off-chain pair, they are on-chain, but the ways you can treat them on-chain are now different. And there's also this term of real-world assets, and the stablecoin, which exists for many years, that basically it's just the first tokenized real-world assets, right? So, and as such, I think they're like the basis of every trade that is going to come on these internet capital markets, and it cannot be overestimated how important it is, not just for the crypto infrastructure, but you mentioned it for emerging markets, access to the dollar, and I think it's like huge volumes we see now, but it's still just the beginning, I think.
When Moritz, I might add one point, one topic we are currently focusing on, and that's also what we previously discussed, is tokenized money market fund. And I think that's, from my perspective, from a visionary point of view, the much more superior product. So our core belief is that in a couple of years' time, all instruments will be tokenized, regardless whether you talk about bonds, stocks, fund shares. Tokenization will be clearly the format of securitization. Then we will have 24/7 trading, and we also have a T0 or second zero instantaneous settlement. And then a stablecoin, in a very best case, is a pure settlement vehicle, and you get a cash inflow. You receive stablecoin, you convert the stablecoin instantaneously in a tokenized money market fund with extremely low bid-offer spread, low transaction cost. And then when you want to release a payment, regardless whether you're a retail guy or whether you're an institutional guy, when you want to release a payment, you reconvert the tokenized money market fund in stablecoin, you start the payment process, and then the recipient again has reconversion into tokenized money market fund. And that's
It works already. I did it last week on 21X. So it was
we have some products already live. So Franklin Templeton 21, they launched Benji, the first tokenized money market fund. BlackRock is, I think, the biggest as of now with a Biddle with about 4 billion assets under management. But going forward, from my perspective, regardless, as said, whether retail or institutional, there's no real need to really have cash positions anymore, which are non-yield bearing. With a T0 settlement, with an instantaneous settlement and 24/7 trading, low transaction cost, you permanently can stick with yield-bearing instruments, and there's no reason not to collect the yield.
Yeah. Claudio, your point about game changer stablecoin?
Stable, if I put, my perspective on retail customers, and I ask now how many people are using USDC or USDT, you can now with me, but how many customers are using USDC or stablecoin just to transfer for your friends here in Europe? Doesn't make, I don't think so. I don't think that works. In the end, if you have a Revolut account, you can send immediately, also during the weekend, and it would SEPA instant money to your friends in France.
Yeah, no, currently people are using PayPal in
exactly. So
Europe. That's,
so we need
Not sure whether you want to use this anymore, PayPal.
There's different uses.
Of course, yeah, sure.
Story.
Yeah, there's different uses. I agree with you that different markets like LATAM, APAC, Africa need this kind of tools because they have to edge against inflation. They have to escape from rules that unfortunately stop transfer money outside the country. So there's different problems. Europe is probably a different story in the stablecoin industry. We know that, probably not just because I'm coming from Turin, but the Tether founders say clearly that they don't want to invest too much until make a change, and also the market changes here in Europe because they make 95% of the revenues and the business outside Europe.
Yeah. We are approaching the end of our time slot, so I have one final question, and I would like to ask each of you to just give a short 1 minute answer to that. So, I mean, we wanted to talk about the future of banks, given the fact that blockchain might replace many of their functions. So looking forward in 5 or maybe 10 years' time, how do you think will the banks exist still as they are today, and what will be the core focus of a bank in particular in Europe, and maybe Ryan from the outside, you may want to start with that.
It's interesting, right? So I touched on the fact that there's the sort of two pieces of legislation, right? Genius Act, Clarity Act that are out there. The White House Digital Asset Report sort of provides an overview of where the evolving role of a custodian, broker-dealer, transfer agent, you name it, regulated, counterparty will be. 5 to 10 years now, it'd be great to see that being implemented, right? More Genius Act, more Clarity Act-like pieces of legislation to address broker-dealers, exchanges, ATSs, other forms. So,
But that means no more banks required, or just these
I would say
functionalities?
it seems like an evolution, right, of the role of banking institutions. Yeah, so I still think a custodian will exist. It'll exist in a very different form. The role of a transfer agent, TBD if that actually exists, 5 to 10 years from now, if everything is in a more blockchain native form.
Yeah, I think that you mentioned a story of the travel agency. Travel agency doesn't disappear. Some of them
needs to focus
on a
niche
niche of the market. I think that will be the future of the bank.
Okay, well found.
Yeah, I think it'll depend on all the products, but to make it as an example, example of a loan is when there is local expertise, then it still be kind of it's going to be still very traditional. And what I want to say is when somebody takes a loan on chain, the lender looks at the collateral and nothing else. It doesn't even know who's the borrower. It just looks at the collateral. A bank looks at the borrower, at his tax income, at his cash flows, at his real estate, at his other assets, and then gives a loan. So I think where it's more this local, let's say, lending against real estate or so, the bank still has like a very local niche. And then on the other things, I think is more, or if they can position themselves as a gateway to that global pool of liquidity and to these global assets. So I think that will be the differentiator for banks.
Yeah. Christoph, will there be banks in 10 years' time?
Yes. Quite funny here, literally at the entire conference we talk about what's possible from a technology perspective. But I guess what's key, and that's I think also the kind of recipe book, how to survive, we have to see it from a client perspective. So regardless whether you are a bank, regardless whether you're an asset manager, regardless whether you're an infrastructure provider, you have clients. You have a service function for your clients. And the one who is reading clients in a very best way, who is anticipating what are the client needs in a couple of years' time. Regardless whether you are large cap tech, whether you are fintech, or whether you are a TradFi player, but that's what you really need to do to assure that you play a relevant role in 5 to 10 years' time. You have to ask yourself the question, why is it we are there? Our goal is, as said, to serve clients in a best-in-class way. And this service is
so easy for the banking industry. Ask what the client wants, and then you'll be successful. With that, thank you very much to my panel. Thank you very much for being here, for attending, and I think our time is over. It was a great pleasure having you. Thanks.
Thank you.
Thank you.